Take a look at the Kenyan Forex scene today. It is structured, visible, and deeply integrated into the local economy. But prior to 2017, trading from here meant operating in a completely unregulated space where you were entirely on your own. Imagine waking up to a massive 500-pip flash crash that wipes out your account, only to discover your offshore broker's website is suddenly under maintenance. For years, Kenyan traders routinely saw their support tickets ignored by shell companies operating out of tax havens, leaving them with absolutely zero legal recourse to recover their deposits. The Capital Markets Authority recognized the extreme vulnerability of local traders and introduced the Online Foreign Exchange Trading Regulations in 2017. This framework required any broker operating in the country to prove they had the capital reserves, the technological infrastructure, and the operational ethics to handle client money safely. The CMA created a legally enforceable shield. Your trades went from being a gamble against an invisible entity to a protected contract enforceable under Kenyan law. If you are an intermediate trader looking to scale up your account today, you have to decide exactly where to park that capital. Many traders are still tempted by the offshore route, intentionally seeking out regulatory arbitrage to access 1 to 2,000 leverage and maximize their available margin. On the other side is the onshore reality, operating within the local framework to trade with institutional precision, secure funding, and integrated fintech tools. This is a direct trade-off. You are choosing whether to trade unrestricted, high-risk access for maximum legal and financial security. To see what a fully compliant setup actually looks like in practice, we can look at FXNX as a benchmark for institutional-grade trading. Where you choose to open your account dictates the tools at your disposal and ultimately decides whether you operate as a retail punter or a serious market participant. To understand the difference in security, we look at how trades are actually executed, starting with the traditional dealing desk or market maker broker. This diagram shows the core conflict in a dealing desk model. The broker acts as your direct counterparty, winning when you lose. The CMA mandates an alternative, the non-dealing broker, acting as an open gateway, passing orders straight to global liquidity providers. If you enter a long position on the Euro-USD, the non-dealing broker makes their money on a transparent spread markup or a fixed commission. They have no financial stake in the outcome of your trade. Those liquidity providers on the other end are massive global institutions, like Tier 1 banks, ensuring your fills are based on actual market depth. Professional traders will gladly bypass the zero-spread marketing gimmicks of offshore platforms in exchange for execution that is physically isolated from price manipulation. Then there is the issue of margin. Offshore brokers frequently try to lure traders with massive leverage limits, often pushing 1 to 1,000 or even 1 to 2,000 ratios. Under CMA regulations, retail leverage is strictly capped at a maximum of 1 to 400. This scale visualizes the math. At 1 to 400, a $1,000 account controls $400,000 in position value. Professionals treat this cap as a safeguard. Extreme volatility instantly collapses an over-leveraged account, while the 1 to 400 ratio absorbs the shock, lowering your probability of ruin. That concept of risk management also extends to the broker's own operations through the requirement for Tier 1 bank fund segregation. A CMA broker cannot use your deposits for overhead. Your money is legally ring-fenced in a separate account at a recognized local institution, like KCB. The final piece of this structural safety net is mandatory negative balance protection. If a catastrophic market gap completely bypasses your stop loss, your maximum loss is strictly capped at your balance. You will never receive a phone call demanding you pay back a debt caused by a flash crash. Operating an offshore account also introduces heavy friction to your capital through expensive international wire transfers and wide currency conversion spreads. This waterfall chart tracks a deposit. Sending 100,000 KES to an offshore USD account loses 3 to 5% to banking fees instantly. But with the local CMA advantage, KES-denominated accounts mean your entire deposit arrives perfectly intact. Local regulation brings local integration. You have instant access to liquidity through mobile money networks like M-Pesa, funding setups on a just-in-time basis. When you finally remove that friction, you can start treating your trading strategy as a proper, scalable business. Treating it as a business means staying compliant. Capital gains from Forex are fully taxable under Kenya Revenue Authority guidelines. Working with a regulated broker like FXNX simplifies this administrative burden by generating clean, formatted annual reports ready for local tax declaration. You give up the anonymity of a shadow account to ensure that your profits are legitimate, documented, and fully protected by the Kenyan judicial system. Unregulated offshore brokers try to sell you the illusion of optimal trading conditions by weaponizing leverage while actively profiting from hidden fees and a closed-loop dealing desk. This matrix maps your choice as a trader, plotting risk against legal security. The offshore model lands firmly in the high-risk, low-security quadrant, an environment built for gamblers. But the CMA framework and FXNX sit squarely in the low-risk, high-security quadrant, required for managing serious capital. To protect that capital, you need a strict, non-negotiable checklist, non-dealing execution, Tier 1 bank segregation, seamless M-Pesa efficiency, and negative balance protection. Take a moment to audit your current provider. Check their credentials directly against the official CMA list of licensed online foreign exchange brokers. If your broker isn't on that list, it is time to reconsider your setup. A sustainable trading career requires a rock-solid foundation.